All right. Well, welcome everybody, and thank you for coming to the President's Effect. Can you believe it? We're 40 days out from a new president. Who's it going to be? Joe Biden, or is it going to be Donald Trump? And then what happens? Who knows? And let me ask another question. Why does it matter? We do this event because we know these questions are going to come up. We hear them. What should I do? What shouldn't I do? What do you think is going to happen? Well, in the next hour, we want to provide some clarity around these questions. We also want to tell you what we believe really matters. And lastly, we want to give you a simple way to invest that we think will make a difference. I'm Leo Terrio. I'm a registered investment advisor representative with Family Wealth Partners. I've been with the firm now almost 7 years, so through 2 presidential election cycles. For those of you who don't know Family Wealth Partners, we are a registered investment advisor. We're registered here in the state of North Carolina. We are fee-based and a fiduciary. We have a home office in Concord. We also work out of Packard Place in Uptown Charlotte. We help our clients with all aspects of financial planning as well as investing. At the heart of our assistance is really education, academic research, and investing science. And you're going to see that in this presentation tonight. All right, let's shift gears a little bit. Let's talk about Zoom. I know a lot of people have been using Zoom through this pandemic and are familiar with it, but let's just make sure we're all on the same page for this presentation. You probably noticed cameras are turned off at this point, and you're automatically on mute. We're going to keep it that way to limit any distractions. However, we do want participation and welcome questions. So we're going to utilize the raise hand feature, which is at the bottom of the Zoom screen. And also, we'll show you that in a minute. And also, we're going to be recording this so we can get it out to you afterwards and show it to people who weren't able to make it tonight. All right, let's take a look at that Zoom screen. You'll see the raise hand down there at the bottom with the red arrow, and then at the top is the view options. So in that section, you can increase the size of the presentation if you need to. Likewise, on the right side, you'll see the divider between the presentation and the presenter. You can move that left or right to increase or decrease those panels. So when you do raise your hand to ask a question or to answer a question, if Keith puts one out to the audience, please wait for me to allow you to come off mute, ask your question, and what we'll do is give a response to the whole audience so everyone can benefit. If you don't want to be on the presentation speaking, use the Q&A right next to that raised hand, type in your question, and we'll read it, and then we'll give a response likewise so everyone in the room can benefit. All right. Last thing, actually one more housekeeping before this. You chose to be here tonight. We're here for an hour. We ask you please limit your distractions. So please turn down your silence, turn on your silence on your phone, shut off email, no Facebook, let's focus. All right, and one more thing before we get to the presentation. I want you to answer this question 2 times right now. So on your notepad, scratch, oh my goodness, Joe Biden was elected. Should you get out of the market? Answer yes, no, true, false. And now do it again. Oh my golly gee willikers, Donald Trump was reelected. Should you get out of the market? Yes, no, true, false. We're going to revisit this at the end and see if your mindset has been changed or if you have a new perspective and maybe you want to change your answer. All right, I promised now we're on to the actual presentation. Keith Leibson is the founder, and fittingly, he's also the president of Family Wealth Partners. He's going to be the presenter this evening. Keith holds a degree in finance, and he's been helping people with their financial planning and investment choices for over 25 years. So going back to Clinton time. Keith is passionate about presenting education like this and investor information like this to people. He's also passionate about helping people with their finances and helping them use those finances to reach their life goals and dreams. Without further delay, Keith, take it away.
Thank you, Leo. I appreciate it. Give me a thumbs up if you can hear me. Yes? Okay, cool. Like Leo said, and like Leo, oh, I got a raised hand already. Leo, did you see that? All right, again, it might have been a raised hand. If not, I apologize. Leo is in charge of that, so we'll get to that in a second.
No raised hand on my end.
Okay, I had a thing popped up on my screen. So just like you all, we are still evolving in this new world with being the best that we can on Zoom. So any glitches, we do apologize. So like Leo said, very often around every election cycle, I get that question. Keith, what's going to happen if so-and-so wins the election? And a lot of times, the reason why you're asking me that question is what you really want to know is how is this election going to affect the stock market? And in turn affect your IRA and your 401k, and should you be doing anything about it, okay? So there are three powerful things everyone needs to realize and know as it relates to the effect any president has on the long-term growth of the stock market. And that is this. Number one, most people think that the president and how the economy is doing and how free or not free a society is, they think that all correlates with how the stock market's going to perform. And that's just not true. And we'll show you that in a little bit. The second powerful thing is this, is that our perceptions and reality are rarely aligned. And the third one, we all kind of already know this one, is that the media overwhelms and confuses us. Okay? So now that we know that we're talking about the stock market, and we'll touch on these three powerful things throughout the discussion. But again, when we ask this question, most people are asking us and talking about the stock market when they're talking to us. So since it relates to the stock market, here's a couple things we need to remember about the stock market itself. And that is this, is that the expectations of the future is already factored into the price of the stocks. And it's only new and future unknown information that's going to affect the market. Now, there's a whole discussion here, but once you start trying to predict what's going to happen, you're just speculating and gambling and increasing your risk. So the price is what it is, and again, it's only future unknowable knowledge that affects the market. Number two, the thing you have to remember about the stock market is this, and again, we'll be hitting this a lot during the presentation, is that stock market returns are not strongly correlated with variables such as GDP. So now what does that mean? All right. So first of all, there's a lot of variables in ways that our government and economists and people will measure how well an economy is doing. And the most common is something called gross domestic product, hence GDP. So when I say GDP, I'm referring to gross domestic product. And you'll hear a lot of, oh, the economy grew 2.3%, or the economy shrunk, or hopefully if Trump wants to beat 3% growth in the economy, they're talking about gross domestic product, or GDP. Another thing, again, you have to remember about the stock market is not only does it not correlate necessarily with GDP, but that even the stock market can provide positive returns even during poor economic times. And the last thing we need to remember is that timing the market is extremely difficult and actually adds more risk and cause more harm. And we'll share all this with you as we continue through the discussion. So these are key things to remember, again, specifically about the stock market. But let's say we got that crystal ball, all right? And we happen to know when there's going to be a recession, all right? Now, what is a recession? A recession is defined back to that GDP. If GDP decreases 2 quarters in a row, they'll say we're entering or in a recession. Now, if GDP goes down 12 to 24 months in a row or drops more than 10%, then they'll start talking about a depression. All right, so on this chart, anywhere you see these red, oops, excuse me, I'm trying to find the pen, there it is. Anywhere you see these red marks, indicates a recession. And that's the most recent one right there in 2009. Now, if we had a crystal ball and we knew we were in a recession or going to be in a recession, and I'll ask for any volunteers here, what do you think you should do as far as it relates to investing? And how do you think the market's going to perform? Good, bad, or indifferent? Anybody want to volunteer and answer? All right, so we might have a shy room today, that's okay. Most commonly, people would think, well, if we're in a recession, then therefore the stock market's going to do poorly. That's the most common answer that we'll get and the most common thought. So let's take a look at that. Here are now all those red marks on that previous slide, and it shows the past recessionary period. So here's 2009, the most recent recession that we had. And that was, if you all might remember, the debt bubble crash, the bank bailouts, right at the end of Bush's term, the markets tanked, and then we went right into a recession. So the economy shrunk almost 3%. But look at, this right here, we see real return. Now looking at the entire US market. So the entire stock market actually was up 24%. Now in 1991, the GDP, the economy shrunk a little bit, and the market did very well, up 30%. And you can see here, the last 4 recessions that we've had, the stock market returns were actually very good. So again, getting back to that perceptions versus reality and their mindsets, hopefully they're starting to show you that it doesn't necessarily correlate. All total, if you hypothetically had that crystal ball and you only invested in the US stock market during recessions, right up here, the growth in the economy during all recessionary periods was a negative 4%. The economy shrunk. But total returns in the stock market was 11%. Now, interestingly enough, when you add all the years back, still good return, but it brought down your return, because that actually means that in the good years, and we'll show you in a second, there were plenty of bad stock market returns. So hypothetically, again, if you were able to know the future and invest it just during recessions, which is counterintuitive, you would have actually had a better return than all the years. Now, we're not saying trying to guess when the good years versus bad years are. Again, we're trying to illustrate, again, that perception versus reality. Vice versa. If you think the economy is going to be great and therefore the stock market is going to do awesome, here is a bunch of years where the economy did very well. Economy grew back in 2018, the economy grew 3%. But the S&P was down a negative 4. 2002, the economy grew, S&P was down. So all these great years were periods of time where the economy shrunk. So again, I apologize, the writing there, I'm still practicing with that. It's hard to do with a mouse. But you can see, again, we're trying to put that point about our perception. It isn't always aligned with reality. And based on what you think is going to happen in the economy does not necessarily correlate what's going to happen to the stock market. And again, we all think in some ways that president will affect the economy. All right. But here's another mindset that we have. And this happened before the 08 election and even Obama's re-election. And we're hearing it now. Now, I'm not saying socialism is good or bad. That's not the point of this discussion. But a lot of people will argue that if we're headed towards socialism or the rise of state capitalism, what that means, bigger government, more government control, that therefore we're going to have a bad economy and it's a bad place to invest because the stock market's going to do poorly. So that's typical mindset. So let's take a look at that. Here was a study done back in the 2000s by a group called the Heritage Foundation, and they looked at variable factors to determine, and these are all countries they looked at that have an actual stock market within their country. And they looked at these countries and how these countries, are they more free or less free? And they looked at these variable factors of rule of law, which includes property rights, and how restrictive or how limited or cumbersome are their governments, and regulatory environment, and trade policy, and how free or not free are these people in these societies' ability to do business. And they looked at this globally, and they came up with this scale, and they identified which countries were freer, mostly free, down to repressed. So the repressed are the red, mostly unfree is the orange, moderately free is that yellow, and then the most free of the free is green. So if you look at this chart and you look at this and you were now to invest your money, where would you think delivers better returns, or where do you think most people want to invest their money when they're thinking about whether or not a country is more socialist, free or not free? Anybody want to venture again for volunteers where you think the returns would come from and where most people put their money? All right. Shy room again, I could see that. That's okay. The most common answer is, well, of course, Keith, we're going to gravitate toward those countries that are freer because they're freer. A government is, the less government involvement, the freer for trade. Therefore, that's a safer place or a better place to be for returns. Well, what did the study show us? It's not actually the case. If you look at developed markets, if you invested $1 during this time period of this study, the least free countries, which is this color right here, actually had a better return. Same thing in the emerging markets. The least free countries had, again, right here, the better return. Interestingly enough, to eventually talk about diversification, if you look at your dollar grew here in emerging markets as high as, these numbers right here are larger when you compare it to developed markets. So that tells you another reason why you want to diversify, that emerging markets deliver returns. But the point again here is that if you're one of those people in the room who's, was fearful before Obama that we're headed towards socialism or too much government involvement, and you bailed out of the market, well, you missed those good returns during his term. And if you're fearful of that, we might be heading this way again, and there's reason for this. One easy reason is that there's maybe more risk in those countries. But the point is, in the least free countries, the returns were there and actually better than in the least free countries. So it looks like we have someone in the chat asking a question. Can we get a copy of the presentation? We are recording this, so we will be sending out the presentation via recording that way. Okay. So hopefully that answered your question. All right. So in summary of those 2 points about thinking whether or not the growth in the economy correlates with stock market returns and how free or not free society is, one thing about that also is that we're not saying that we want to, that socialism is good or bad, or a lot of times if there's a bad economy and low growth, that's not good for our wallets. It's not good for our pocketbook. There could be unemployment, maybe lower standard of living. But again, as it relates to how you should invest, what we're trying to show you here is that lower negative growth in the economy does not necessarily predict or correlate with future stock market returns. And a robust economy and economic freedom, again, while it's linked to higher incomes, better education, increased life satisfaction, it doesn't always correlate with higher stock market returns as well. So hopefully we've hit that point well here for you, and you're starting to see a little bit of what we're trying to illustrate here in this discussion. All right. Any questions so far? If you have any questions, again, feel free to raise your hand. But we are talking about the president's effect, right? So an interesting little discussion is we're going to take a look at all past presidents and, how did the market perform and what did it do? So to start with this discussion, I'm going to highlight here first these right here. These are 5 categories in the US stock market. The most well-known right here is the S&P 500. Then you'll start seeing us, we'll say CRISP, and I'll explain that in a second. CRISP right here, 910, 610. Then you have US large value and small value. So anywhere in any discussion I give where I say CRISP, that stands for the Center Research for Security Pricing. It's an organization that has a decibel scale from 1 to 10. And this identifies the size of these companies in the entire stock market, whether it's US or global, all right? So the decibel 1 and 2 is your large companies, your S&P 500. And those are companies that are as big as 10 billion and larger. When your decibel 9 and 10s, those are your micro caps and your small caps. and those are 2 billion and less in size. All right. So now we're going to look at these 5 categories in the U.S. market and how they did during different presidential terms. So here you see during Calvin Coolidge, the S&P, $1 would have doubled to $2. Then your crisp 910, that's your microcap and small caps, also almost doubled. Then your mid caps, $1 to $1.75, and your large value, again. So you saw across the board there was growth in all categories. But now we had the Great Depression during Herbert Hoover. Now, right across the board, you'll see, yes, every category did bad. So there was losses in the stock market across the board during the Great Depression. World War II, Pearl Harbor, during Franklin D. Roosevelt, pretty bad, I think. I mean, I wasn't alive during that period, but I don't think World War II was a very peaceful period of time. Probably a lot of anxiety in society. But look at the stock market. Your S&P, your U.S. large caps, $1 would have grown to almost $5. A case for diversification, those small and micro caps. $1, 28 times its value it grew. Your mid caps, $1 to 15, and your value, $1 to almost 7. Then we've got, under Harry Truman, start of the Cold War, U.S. labor disputes, railroad strikes. $1 in U.S. large grew to 3. Microcaps, 2.8. $1 grew to 2.7 here in value. Again, you're starting to see a theme. All the categories grew. Now, whether or not you are for big government or not, I know people have different opinions on that. But a lot of mindset and a lot of people do believe and feel that the bigger government gets, it could be, again, not be good for the economy, which could affect our pocketbooks and how you do business. But again, does that relate to negative stock market returns? So here we have the largest U.S. expansion in history of the government, the creation of the Department of Health, the creation of education, the Department of Education, and the creation of the welfare through government. All the 4 categories are illustrating back then that existed, tripled in value. All right. Next president, JFK was assassinated. Oops, sorry. Nope, where was I? We had a Cuban Missile Crisis. That means there was a nuclear warhead 90 miles off the shore, a Russian nuclear warhead 90 miles off the shore of Florida. The president was assassinated. We had Vietnam War going on, while not robust growth, but there was, little modest growth in, again, all categories in the stock market. Lyndon Johnson, Vietnam War, Martin Luther King assassinated, Bobby Kennedy assassinated. U.S. large, some modest growth, $1 to $1.66. Another case for diversification. If you weren't already in the small caps, if you're waiting for the returns, you're chasing it, bad idea. You got to be in the category before the robust returns come. Small caps, micro caps grew 4 times in value. $1 grew to 4.5 almost. Your mid caps, $1 to 3.5. Richard Nixon, Watergate. Obviously not a good period of time. Now, I'm not saying volatility isn't here. If you really see, you'll see the volatility. All right, we're going to start talking about later. If you're diversified and you're disciplined and don't make mistakes, the returns are going to be there. But yes, in this window, large cap shrunk a little bit. $1 shrunk to 91. Everything was down, small caps. Your large value actually was flat. So there was a category that didn't do too bad. Not great, but it was even. Here we got Gerald Ford, energy crisis, beginning of high unemployment and high inflation. I like to skip to the next one because this is when I start remembering things going on in the world, which is the dovetail of all that. Jimmy Carter. During Jimmy Carter's return, his period of time, we had double-digit interest rates. Now think about that, if you know what that means. Mortgage rates were 12, 13, 14%. Now, you could get a mortgage now at 3%, 3.5%, 4.5. Imagine borrowing at 12.5%. Inflation was rampant. There was gas shortages. There was lines at the gas station. That's the part that I remember a little bit back in the day. I was only, 10, 11 years old during this time. Iran hostages. But still, U.S. large grew a little bit, $1 to $1.55. Your micro caps and your small caps more than doubled, almost tripled in value. Your mid caps, same thing, double, tripled in value. Your large value grew a little bit. Again, you're starting to see the theme here. Ronald Reagan. Now, Ronald Reagan's term is the economy was great, right? Stock market returns were stellar, right? Triple, doubled, tripled. Large value, one grew to, almost 5 times in value. Small value, $1 would have grown to almost 6. There was still bad stuff going on. Still escalation of the Cold War. The embassy in Beirut was attacked. We had Iran-Contra hearings. And there was a stock market crash, one of the biggest, 1987. Right? There was a huge crash in the stock market called Black Monday. But still, if you were disciplined and diversified, regardless of how you felt and you stayed put, the returns were there. Desert Storm during Bush 1, modest growth across the board. Bill Clinton, so much remember, the tech bubble, the tech run, right? But there was some bad stuff also that happened during Clinton's term. Some people might not remember this or know this, but there was a bombing at the trade tower. They tried to blow it up once before 9/11. They had a couple trucks in the garage underneath that exploded, tried to take the towers down. Timothy McVeigh set off a bomb in front of a federal building. And we had a warship attacked in the Persian Gulf, I think it was, U.S. coal. With great returns, again, across the board. George Bush, September 11th, not a good period in our history at all. Iraq war, and then ended it with the huge, again, that last recession, the crash of 2008. So yes, that was reflected. U.S. large shrunk. $1 would have shrunk to 79 cents. But here's another case for diversification. If any of my clients are on the call right now, you remember me telling you, I know the losses stink, but it could have been a lot worse. But we had money in the small caps. We had money in small value. We had money in mid. And look, those categories actually had a positive return. But we all were focused on one those that were focused on one category felt more pain. But yes, bad stuff happened. Losses in U.S. large, but there were categories that actually did well. And then Obama, despite all the fear mongering, again, people will differ on how you felt, whether or not he was good for society and the economy itself. But as it relates to the stock market returns across the board, again, they were there. And if you bailed out before Obama, like you're thinking maybe to bail on it now because you think we're headed towards socialism, okay, you missed out on that. If you got back in, you probably missed out on some of the recovery. And then the jury's still out, of course, on Trump. And, again, I get a lot of my data from firms because we have to be compliant. And the last time they updated this data was through 2018. And there was still modest growth in some of the categories. And again, the jury's still out on how the stock market is going to perform during that. But again, the theme is this. If you had just vested $1 when the stock market started, and this based on this discussion, in the U.S. large, that $1 would have grown to $4,800. Interesting enough, again, that case for diversification, if you, I'm not saying put it all in small cap, but if you had that $1 in small cap, it would have grown to $195,000 with a lot of bad stuff going on and lots of different presidents representing different parties. And despite all that, we're going to show you later, if you invest the right way, the returns are there. In this time, while COVID might be different, but this time is not different. And like I said, if you're disciplined and stay invested in the beginning, despite who the president is, the long-term growth of the market has always been there. All right? That makes sense. I can't see a raise of hands. Usually in my room, I could get the raise of hands, but hopefully we kind of hit that point pretty well here. If you have any questions, again, I see I got a raised hand. So, Leo, you want to give Scott the mic?
Actually, Scott had a question that went back to the freedom slides.
Okay.
So he was asking, but are least free countries also the most economically depressed? So I don't know if that was something that was covered in the study that you referenced.
If I heard you correctly, were the least free countries most economically depressed?
Right. So we showed that their stock markets could actually do well, but are they the most economically depressed?
Oh, great question. And Scott, and if that's the same question you had with the raised hand, let Leo know, or else we'll still get you back on the mic. The answer, again, if I know there's a lot of content here, and I've tried to hit on that point a couple times. Scott, you are, I think, correct. There's a different discussion between GDP and the economic success of a country and stock market returns. So yeah, if there's an economically depressed country, yeah, that could lead to more famine, more poverty, starvation, and those are not. I'm not saying those are good. Those are not good things. But the mindset is people will think, and again, if you relate it to say a country like America, who maybe was mostly free, and if people are thinking that we're going to head towards a repressed society, or they don't want to invest globally because of economically poor countries, that is famine or poverty or lower standard of living, or we're trying to illustrate that does not necessarily correlate with poor returns. So yes, they are economically depressed, and that's not a good thing. And we want them to have economic growth for sure. Did that answer your question? I hope it did. And then anyone else have their hand up? I see a bunch of chat going on, Leo. So let me see if I can. Okay.
Scott said no other question.
Awesome.
So I'll just add to that. So yeah, so investing in those economically depressed countries are, like Keith said, possibly more risky, but that's how we're building them up into growing economies that can produce revenue and produce for their supply and demand of their needs in the country.
Yeah, and a lot of times also, and I think I have clients in this discussion too, is I'll get those questions because we always talk about investing globally, and they'll say, well, Keith, why does this portfolio own, we'll say Russia, or own these countries that are economically depressed, and that's what we talk about. Well, because there's still returns there, and if you diversify properly, we'll talk about later, you're still going to capture those returns. And the question is, how do you do it in a way that manages your risk and volatility? And sometimes the mistake that people make is when they see great returns in those categories, then they'll chase it. We're trying to say you don't want to exclude it from your portfolio, and don't have that mindset that returns aren't going to be there because they're economically depressed, and that they are. And if you feel a country's heading towards that route, you still don't want to bail out of the stock market in the U.S. because you think if so-and-so wins, that's where we're going. All right? Because again, we're trying to illustrate the returns are still going to be there. It's a great question. But like we said earlier, the three powerful things to remember is the media. The media is not your ally. The media's purpose is not to help you be a good investor. Does anybody want to venture a guess what the media's purpose is? Anyone want to chime in on that one? It's kind of an easy one. But to save time here, I'll kind of answer it. The media's purpose is not to help you be a better investor. The media's purpose is to get you to watch or to click. And the more watch, the more eyeballs and the more clicks they get, the more they can charge for advertising. So they put in out, exaggerate in their titles. So let's kind of look at that as it relates to this discussion today. So after Obama wins back in 2008, ABC's reporting, and this happened. The stock market's tanked. People panicked. They bailed, right? And why? Because they're either fearful of Obama or he's inheriting that bad economy from Bush, from the tank, right? So if you read this and you believed it and you behaved based on it, the reaction was that you got out of the market. And if you remember what I showed you before in the discussion, while there might have been volatility, if you stayed diversified and stayed put, the market did very well. And we're going to share a little bit later on why trying to time it is very risky. And the re-election again is Obama. Back to that socialist discussion. Not saying that socialism is good or bad. Everyone has different opinions on that, right? But a lot of times when it's put out there, it's really put out there as a negative, and people take it as a fear, because yes, it might be bad for, economic success, but does it correlate to bad returns? Hopefully we hit on that before. But again, the media is putting out, or people is reading that, is he a socialist? And therefore, how should you behave when it comes to investing? And this is an interesting little quote. This was in January 16th. Title: Stock market crashes the same week we're celebrating economic recovery. So back to that mindset versus reality, kind of oxymoron, right? The economy is recovering, yet the same week the stock market crashed. So, again, that's not what you would think really would happen. So it doesn't really correlate, right? This is an industry periodical that I subscribe to. This is back in 2016. Again, putting out fear. The presidential election fear factors puts the economy at risk. Therefore, what's the mindset? Last election, a Trump win would sink stocks. What about Clinton? Right? So again, if you're fearful of a Trump election, it's going to sink stocks, so you're going to get out. Right? Now, before COVID, the stock market did very, very well. I like this slide. So this was two conflicting articles. So here you go. This was August 10th. Get ready for a Biden stock boom. Or if you read this article July 10th, President Biden, would be brutal for the stock market. So which one is it? Boom or brutal? They don't really care. They're getting you to read and click so they can sell more advertising. Here's a fear article. You better be fearful. Again, not saying we don't have to agree on the policies, but this article is going to fear you. Stock market's going to plunge if he wins. And I have clients, unfortunately, they're telling me, Keith, if Joe Biden's going to win, I want to get out. Let me get out now. And despite how I feel or they feel, I think you know what I'm telling them. You don't do it. Another article, this is past August, based on the current election. U.S. stocks are going to rise regardless. Okay, now it's going to go up regardless of who wins. Okay, that's not bad. But don't read this article. This one is not even a couple weeks later. It's going to be rocky no matter who wins. All right, so Reuters is going to rise regardless. And then Barron's is going to be rocky regardless who wins. Or the worst nightmare, and you're starting to hear this now, right? If the election is contested, what if we have no winner at all? Right? Then it's going to be our worst nightmare, regardless. All fear and greed. The bottom line is this: the media is not your ally. They're feeding on your emotion of fear and greed. And I'm getting a message right here. I might have a little unstable connection, so hopefully I don't get too slow here. The media is not there to provide prudent advice, plain and simple. Hopefully we start to illustrate that, and you kind of already know that one. And the point is, this uncertainty happens all the time. And hopefully I showed you back on the whole president thing, showing the different years, there's always bad stuff going on to every presidential election. The incident might be different, but bad stuff and uncertainty is nothing new, regardless of who the president is. So what do you do about it? Now that I've had this whole discussion, what should you be doing? How do you become a better investor? What do you do despite all that you just learned, or in lieu of all of what you just learned? Is you focus on what you can control. And that's the correct investment approach. And you forget the rest. You forget what the media is saying. You forget if if this person wins or that person wins. You forget what's going on in those moments. It's really not relevant. So what do I mean by that? You focus on what you can control, which is the right way to invest. So I'm going to start teaching you that right now, or re-emphasizing that for the people in the room who already know me. This was a study that was done by Brinson Biebauer. And what they did is they looked at these huge pension plans. And these pension plans had people who are managing all this money. So you have government pensions. Now, pension plans are kind of going away in the corporate world. Those are those plans that used to give people income for life or a lump sum when they retire. So there's a ton of money in these pension plans. And the government still has pensions. But they looked at these pension plans, these huge pension plans where people are managing the money. And they kind of looked at what is the determinant of the actual performance of those portfolios. And this applies to individuals as well. And the study showed this, is the number one driver of performance is how well are you diversifying your money amongst all the different categories or asset allocation. So I'll show you more what asset allocation means, but how much in large, how much in small, how much in US, how much in international, how much in emerging markets, how much in fixed income, how much in cash, that's asset allocation. That made up the majority of the performance of their portfolios, of the returns. The other factors, market timing and stock picking, which, by the way, is where most of your media, if you start thinking about it, usually when people come to me and ask me questions, say, what are you talking about? You're just talking about market timing or stock picking. That's what the most of the media in industry pushes. And most people think they should be doing. Those actually had a much less effect on the portfolio return. And interestingly enough, when I look deeper into the study, the impact of the market timing and the stock selection of these pension managers actually added a negative return to the overall return of those pensions. So what that meant, if they had eliminated the market timing and the stock selection, they would have had a better return. So really what you can control is your behavior and doing it right, which is right allocation and the right diversification. Those are the drivers of return. Hope that makes sense. Again, I can't see the head nodding, but hopefully it's all out there. So let me kind of educate you more on what I mean by that. So right here you'll see in this color chart, we've got multiple asset categories. So the blue is US large, the green US large value, the gray is bonds, that color is small cap, small value, short-term fixed income. Hold on, I got a question. All right, it wasn't a question, it was a comment. Thank you. Thank you, Laura, for that. Appreciate it. International large is red, international small is green. So what you'll see here, this shows you back to 1973, the best asset category and the worst. And it shows you the best performer. And right here is back in 2019, you can see US large is the best asset category. But if you look really deeper at this chart, you'll start to realize there's no rhyme or reason which categories could be the best category going forward. So the mistake people try to make is they try to predict it, which one's gonna be the best and put their money there. But when we talk about the right way to invest, asset allocation is you own them all at the same time in a diversified portfolio. You don't try to guess, all right? And then what I'm gonna talk about a little bit later on is your rebalance. So what rebalancing is when you have them all in a diversified portfolio and the portfolio gets out of whack, right? Because there's always stuff doing well and bad. The human element, what the mistake people make is they say, darn it, look how bad these categories did, and they chase the better category. And they end up selling what's low and buying what's high. That's not what you do. You own them all, and I'll show you the pie chart, the right allocation. And then when they get out of whack, you're supposed to rebalance. And rebalance is because something's overweighted, you're constantly taking that growth off the table and redistributing it to the underperforming categories. And by default, you're selling high, buying low, keeping your allocation consistent, which brings down your volatility. That's investing, right? Because nobody knows the future. So hopefully that makes sense. And then it looks like that. right? So the only choice is, and you all see these pie charts, the only choice is, you'll see here, if it's aggressive, it's equity is stock versus fixed income. These are just 4 examples. It's really down the scale, a lot less stock, more fixed income. It's how much you have in versus stock versus fixed income. But all the stock categories are the same. It's just as you go down the scale to more safe, you just have less in the stock market. But you have all those same categories like I showed you here. All right. And then you just have that more fixed income, which brings down the portfolio volatility. And you just choose the right allocation based on time horizon and purpose. Right. If you're getting close to retirement, yes, you're not going to have 95% in the stock market. You're going to have maybe 25% in your portfolio. A lot of my clients will have various buckets. We'll have some money, even if they're retired, that's still growth oriented. But again, it comes back down to how, if you have a kid going to college in 10 years, you might shift from aggressive down to moderate or conservative. That's investing. What I'm teaching now is what you're supposed to be doing. All right. So hopefully that makes sense. And don't market time. Again, getting back to this, don't try to guess what the best category is going to be. Don't, bail out of the losers and chase the winners. All right, which end up the following year, the winner that you chased is now going to be on the other end of the scale, the loser. All right, that's trying to guess. That's trying to market time. Don't do it. And here's why. Here's an example. And every time we get this slide updated, it's the same story every day. If you're trying to market time or your managers, very commonly, we talk about it in other classes. So the market timing can happen at 3 levels. Either you, the individual's market timing, getting in and out of the market or in and out of categories, chasing. Sometimes it's your advisor, right? Your advisor is saying, hey, let's get out of the market or let's get into the market. And the other level that can happen is inside of your products. Most people are using actively managed products, and there's market timing going on in there, all right? Here's the problem with market timing. When you market time, you have to be right at least twice. When to get out, when to get in, all right? And the problem with that is that when markets do bad, usually the recovery happens fast and furious. And a great example is just recently back in March, during COVID, the markets tanked. All the value of the first years of the Trump administration, they lost all the value back to where he started. Within a month, all that loss came right back, right? So if you panicked or your manager panicked or your advisor was market timing because of COVID, well, 3 weeks later or 4 weeks later, COVID didn't go away. The concern or the fear didn't go away. So you're getting back in the market? No. So what ends up happening is you missed the recovery because you got to be right twice. So here's what happens. If you had just missed in these 5,000 trading days in this time period, if you invested $10,000 just in the U.S. large growth, S&P 500, 10,000 would have grown to 41,000, was $42,000. If you just missed the 5 best trading days, or the 10 best trading days, or the 15, or you missed a whole, say, recovery, 30 days, you would have parlayed your 10,000. You would not have had 41. You only would have had 8. You lost a lot of that growth. Okay. So again, market timing is very risky. You have to be right at least twice. And again, the main thing is if you're fearful when you got out, usually you're not getting right back in when that recovery happens. You're waiting to see, and you already missed that first recovery. You're waiting to see if it lasts, and you really, a lot of times, did irreparable damage to your returns. Okay? But no matter what I say, some of you are still thinking, yes, but don't the experts, can't they do it right? Now, in other classes, I show you how often, statistically, how often the active managers still don't get it right. But let's say you still don't believe me, and you happen to be lucky enough to be in the top 30, the best funds during the last really big crash in 2008, right? So you're lucky enough, or people say they use this as evidence. Well, look, Keith, if I haven't been the best ones, even though I show my other classes, the people who tend to beat the market don't tend to repeat. They usually don't. But here in this example, the top 30 U.S. equity funds, actually after the Bush term actually had a combined average of 4.5% return, even after that huge crash in '08. Not bad. This is all their peers. Their peers ended up, the average of the peers was negative, so they beat the peer group. The S&P, they beat the S&P, had a negative 2.19. And then here's that CRISP again. Now this is 1 to 10. That's all the way to the microcap, all the way up to the large. Lost. So again, if they can market time, A, and if they can consistently beat their peers in the S&P, what do you think happened after that crash? You would think they would have repeated. But here's the point, they didn't. So not only did they not repeat beating their peers, okay, they missed it. The following 5 years, the S&P right here had an almost 18% return, but those top 30 managers only had a 6. So yeah, maybe they got out and they saved you from pain, or your advisor got out and saved you from pain during that crash. But again, you did long-term damage to your portfolio because you're most likely going to miss out at some part of the recovery, if not all of it. All right, so hopefully that makes sense. Don't market time. You don't do it. Don't let other people do it with your money either. It's adding more risk. And if they get it right once, they do it again. The more they do it, the more likelihood eventually they're going to get it wrong, like any other form of gambling. So to summarize that part, investing is simple. I know people are saying, no, it's not, Keith. That's why we're on this call, and that's why we hire you. But it's important for you to understand and get this in your head and hopefully use these classes as reminders. All right? So the first question is, again, in order to get the returns that are there, you have to have money in the stock market. And so getting back to those pie charts, how much in the stock market does depend on your time horizon and risk tolerance. Okay? But you have to be in the game to get the returns that are already going to be there. And do not market time. And also eliminate the stock picking. We didn't get into this in the class, but the active management by you or by other people, or most commonly inside of your products. If you don't know what I'm talking about, we'll offer time to meet with us. I'll show you the active activity that goes on inside of a lot of your portfolios. Don't market time and don't let people stock pick with your money. And then diversify correctly, right? The right allocation, how much in stock, how much in bonds, within the asset allocation, not just US, own the microcap, own the small cap. Again, do it globally, own emerging market, own international, the right way like I showed you in those pie charts, or again, other pie charts you always see, and do this globally. And then get back to that rebalancing. And again, rebalancing, to remind you, is not market timing. Sometimes people say, well, Keith, isn't rebalancing market timing? No, it's not. We get back to those pie charts. Again, for my clients in the room, if you're whether the aggressive, long-term growth, income and growth, and we have portfolios in between these. The rebalancing isn't market timing, is that through all those categories, right, behave differently. What you're doing by default is you're rebalancing back to your targets. And that brings back your volatility down, right? Because if something's gonna run up and you never rebalance it out, eventually that category tanks. So if you never rebalance that growth out, you're going to have more loss when that category actually ends up doing poorly. And rebalancing also on average will add a return. Why? Because you're by default buying those categories on sale. So again, be in the stock market, eliminate the active management, diversify correctly, do it globally, and rebalance. All right? Now, most of you, if you have money in 401ks, the best thing for rebalancing is take the emotion out of it. You can usually go into your 401k and set up automatic rebalancing. There's usually a feature in there. Okay, you can choose to do it quarterly usually. And some of your, IRA platforms, I know with ours, I use platforms that do it automatically, right? Because I don't want to have to manually go in everybody's portfolio and rebalance. For those that don't have the automatic rebalancing your 401ks, and for our clients, what we'll do is we'll spreadsheet it out, and once a quarter, once a year, we'll put in their values and see if any of the categories are out of balance. And that's investing. And the only thing beyond that is you need to stay disciplined. And yes, I know it is hard to do, okay? And then beyond that, you just shift your allocation as your time horizon shrinks. So if I have a client and they say, Keith, yeah, we're in growth, but I'm going to retire in 10 years. Well, then yes, we're going to start, even if we think the market's going to do great, we're going to start shifting your allocation down that scale to being more safe or more secure and having a lot more money out of the market. Why? Because you're not going to be, when the market's tank and I hear, oh my goodness, I needed this money for my kid's college, or I need it for retiring, the mistake isn't the market's tanked. The mistake was that you had not been shifting your allocation down the scale, all right? So that's what you need to be doing. So that's investing, all right? Any questions on this? If so, just kind of raise your hand. All right, cool. All right, so summarize it. Turn off the financial media and the news. What's going on is irrelevant when it comes to what you're doing and how to manage your investments. And remember, it's your emotions and how you feel that will lead to behaviors, either you, and again, it's, you as an advisor, I see advisors that fall into these traps. It's your behaviors that will derail you and that are counter to prudent investing. It's our fear and greed will destroy your wealth. Again, prudent strategies will grow it. So tie this all together. Our perceptions and reality don't always align. Hopefully we hit on that. GDP doesn't always align with how the economy does. Who we think the president will affect doesn't always align with how things will do. The media plays a big role in our mindset. Correlation or not, your strategy should not be related to an upcoming election, the president's policies, or how well the economy is doing, or anyone's forecast of the future. And do not succumb to this time is different, okay? Focus on returns really come from and what you're doing and why, and stay disciplined. And yes, I know that is hard to do. And again, turn off all the other noise. And if you feel a lot of times people, how you feel is not abnormal. Even a lot of my clients, this stuff creeps into your mind. Give me a call, all right? We'll review this. I'll refer back to these educations, all right? And if you're not a client, I'd love to help. Still give me a call, all right? So Leo had you write down in the beginning your answer. So take out that piece of paper and let's do it again. Oh my goodness, Trump was reelected. Should I get out of the market? Oh my goodness, Biden won the election. Should I get out of the market? Write down your answer. Anyone's answers change? Anybody maybe want to share something they've learned through this discussion that might have had an impact on how they answered this question in the beginning and how they're answering it now? Do you have a Q&A? There you go. Buy more. Yes. Good point, Laura. And that's something, thank you for saying that. Not only buy more, a positive is if you're diversified properly, right? Volatility is actually your friend, because why? If you're putting money in every single time in your paycheck into your 401k, you're buying all that on sale. Or if you're putting money in every single month in your IRAs, you're buying it on sale. So yes, buy more. Thank you, Laura.
We got Scott in the chat. He said no and no. He knows when he sees market timing, I think.
Okay, good. Thank you. Thank you, Scott. Awesome. Anybody else want to share? All right. That's okay. We got a shy room. No worries. So hopefully you learned something from that. And to summarize and to follow up real quick. Oh, we got another question here. Okay, Laura's comment. So we have to change the Q&A to a comment section. Thank you, Laura. I love it. I love it. A lot of times I am asked when I do these classes, so Keith, thank you so much. The education is great, but what do you get out of this, right? Where does your company fit in and where do you fit in? So first of all, what I get out of this is I love to help people, and we are a firm believer that a rising tide lifts all boats. So if I'm helping people become a better investor, have more peace of mind, at some way we all benefit from that. So that's really one thing that we get out of it. But also where we fit in is, yes, like Leo said, we are financial advisors. I've been helping clients for over 20 years. I have real life experience helping people in good economies and bad economies. Really, as an investor coach and a financial advisor, we help people with their 401ks and their IRAs. We are fee-based, which means we are not commission-based. There's no cost to get in, no cost to get out. As long as you like working with us, we just get a fee that comes right out of your account. And we talk about that when you hire us. We also do financial planning. A lot of our clients, we believe more in just helping you with your investments. We work with, retirement planning, college planning. I help a lot of our clients with benefit enrollment. Health insurance is a big discussion. We can help you choose what plan might fit best for you, and whether on the HSA health savings account works or doesn't work for you. But a lot of financial planning we do, and then again, this ongoing investor education. So if there's anybody maybe that likely to learn today or wants to maybe discuss any more of these topics or anything that we talked about, in the chat, and we will also follow up with this link, but in the chat, Leo's going to put a link to a request for a strategy session. If anybody wants to talk about anything I learned today, there's no cost. We'll get on the phone with you. We are meeting face-to-face. If anybody's out in the world and wants to have a face-to-face meeting, we welcome that here, either in our office in Concord or down in Charlotte. Just click on that link, fill out that card, and then someone from the office will reach out to you and for me to talk about any of these topics that you might want to discuss with us today. So I do see I have some other maybe chats or questions, but we do want to finish this. Thank you all for coming here today. We hope you learned something, and we'd love to see you back at future. We will be doing more webinars, and hopefully eventually getting back out into the public and doing some face-to-face meetings as well. So if anybody has any questions, now's a great time to ask them. If not, let me see. Very nice. Thank you. Appreciate that, Scott. Thank you very much for participating. And if anyone else has any questions, if not, thank you very much. We'll stay on here for a little while. Enjoy the rest of your night, and thank you again for participating. Enjoy the rest of your night, and thank you. Appreciate it.
Thanks, everybody.